So I'm going to go ahead and get started. Today we're going to be talking a little bit about a section of Gary Keller's book Shift, which deals with the creative financing. So it talks about the different ways of financing in a shift market to make your homes more marketable, your buyers, all of those things. Before I dive right into that, I'm going to go ahead and launch my screen, and I can't do that yet. Hold on. Okay, I got to share it first and then launch it. So share. I'm going to share this desktop, share, and then I'm going to launch. And then you guys tell me, okay, what do you see on your screen? Because I don't. Oh, I see me over here. Can you
I see.
see? Can you see creative financing with the Shift book?
Yes.
Okay. So now I think I'm recording, which is perfect. Okay, so here we go. Knowing your financing options and strategies will help you in a shift market, right? Shift. I said shift, not shit. Okay, I said it. Anyways, let's do a little financial market update so you guys kind of understand what's going on, because there's the good, the bad, and the ugly that have kind of gone on with the changes with COVID, that most of you are or are not aware of. Um, and there's a lot of reasoning behind that. When the government comes out and just says, hey everybody, you can not make a mortgage payment for 6 months, and we've talked to these banks and they're going to let you not do that. And there's pluses and minuses to that whole option, and it also puts a lot of people in a poor situation. Can everybody just mute yourself right now, and then if you want to talk, click unmute? I hear a little bit of rumbling in the background, so I want to stay on focus. I'm going to talk. Well, the first thing, the good news is iBuyer is gone. So obviously, iBuyer works in a market that's going up, and in an unstable market like we're seeing right now, where people aren't sure what's going to happen because we don't really know. We still are seeing home sales. We are seeing some decline in home sales. We're seeing decline in financing as well, but the iBuyer market is gone, and I personally believe the iBuyer market is horrible for our communities. And I mean, think about it. It's bad for values because they're buying these properties at 25% under market on average. It's stealing the homeowners' equity from them. Obviously, it was a quick way for them to do that, and all of a sudden they learned the hard way that it wasn't the best strategy, based on I'll tell you in a second. But also the homeowners fees, they're lying. I don't know if you've ever put these side by side and see what they're telling the homeowners, but they're literally lying about the cost to sell the property, and their fees are even more. By the time you add it all up, you're losing tens of thousands of dollars versus listing with a real estate agent and making it happen. And then the values are lies. So basically, the CEO of Zillow made a announcement that they were canceling all current contracts. So they were no longer doing purchases on homes, and they were canceling all current contracts. What does that do? I mean, these are individuals. Could you imagine you're sitting here, you've bought your new house or you've bought another home, you've used their program so you could expedite that and buy that house and be non-contingent, and all of a sudden they're going to pull the rug from you. Oh, but he's doing it in a humane way. So don't you put your dogs down in humane ways? Is that kind of the same thing? So I think for you real estate agent, it's a pretty powerful tool when you're out talking to the public, and maybe exploiting some of these type of programs, which are just bad for communities. They're across the board. So some of the bad things that have happened with the government mandates, no payments, no foreclosures, have put a lot of stresses on the servicers in our industry. So those stresses on the servicers have made it, when you don't make your payment any longer, that servicer still has to pay those payments to the investors. They still have to pay the taxes. They still have to pay the insurance. They have a contractual obligation to do that. So that money just doesn't come from anywhere. So when those services run out of funds, they're done. So what are they going to do with all these people? So this is a whole nother crash on the rising. Well, Ginnie Mae, who has about $60 billion in reserves, steps up and says that here's what we're going to do. Anybody who has FHA, VA, USDA, we're going to go ahead and we'll replenish those funds to keep you in business. So it's going to be a, another kind of a bailout kind of situation happening directly from Ginnie Mae, who's going to help do that. And it's basically, it's the all participants memorandum, APM, which goes out to all servicers. Now here's the other side of that coin. Freddie and Fannie don't have that. I don't know if we all remember, but Freddie and Fannie were put into conservatorship by the government, and that was after the last crash. Well, they never took them out of conservatorship. I mean, typically you'd be in conservatorship until you start making money. Well, the government was profiting, or the Fed was profiting so much. I mean, billions. They were, I mean, more money than Apple or Windows or Bill Gates or any of them. They were making billions of dollars, and guess what? They never paid back any of the money that was the reason why they took them over for the bailout. So the bailout they paid zero. They have that. So had they given the controls back to Fannie and Freddie and made them private again about 6 years ago, they'd have more money in reserves than Ginnie has to help do the bailout. So right now we need FHA to come in and follow suit, because those servicers are going, hey, you mandated us to give them 6 months of no payments and then give them an extension of another 6 months and not force any foreclosures or file any lates. But at the same time, where do we go for this money? So we see that on the horizon, but that's the ugly part of what's going on. The other ugly part is that because of some of these mandates, because the government has said no foreclosures, you don't have to make your payments, a lot of the private investors bailed out quickly. They were the first to go, forget it. So your alt doc, where you're doing bank statement programs, don't exist. Your no doc programs are gone. They don't exist. There's nobody buying that product. So they're just not, they're gone. They're off the market. Jumbo, high balance, and high balance fees have all been adjusted. They're concerned about churning. A lot of the jumbo products have changed their guidelines. A lot of the jumbos have gone back directly to the banks because everybody's so impacted with the amount of volume of loans. Because when the Fed says, oh, we've brought the Fed rate down to zero, everybody thinks, oh, interest rates. Fed rate has nothing to do with mortgage rates. Fed rate is short-term rates, your credit cards, your cars, that kind of stuff. Interest rates usually can follow where the Fed rate goes, but they have nothing to do with how those interest rates move or don't move. So right now our rates have, what has caused our rates 2 weeks ago to drive down was the Fed started spending $50 billion a month in bonds, and everybody in the mortgage industry was like, whoa, slow the hell down, because we can't handle this, because we're locking loans and people are bailing on those locks because the interest rates keep going down, and all these servicers were going to have more compounded problems because they're not proceeding with their locks. And when you don't proceed with the lock, you have to pay money. I think it's about 75 basis points. So it costs the lenders a lot of money when somebody makes a commitment and then they don't follow through with that commitment. So this is the good, the bad, the ugly, the updates on the market. Does anybody have any questions to any of that from what I've said? Okay. If not, let's move on. So, shift market. What does the shift market mean? Basically, it's a change in affordability. So when we're shifting in a market, we were in a seller's market. The pendulum is now shifting towards a buyer's market. And typically, when the pendulum shifts, you know, it's a seller's market, seller's market, seller's market, seller's market, seller's market, and then boom, it's buyer's market, and it goes, and it usually is in this shift period for a very short period of time. We're in a unique situation though, guys, because as soon as everybody goes back to work, we've got 10 million people out of work right now. 70% of those are probably going to go back and have their jobs as soon as they lift the quarantine. Boom, they're back to work. 30% of those are like, okay, my job doesn't exist anymore. I got to go find another work. Some of them probably didn't even work. Somebody have a question? No? Okay. So, point being, the market, we feel like on the lending side, we think that the problems we're having with jumbo and high balance right now, and literally the problem that we're having with those has to do with the cost. So it's literally their margins on those are so skinny that the borrowers are having to pay to get those loans, or they're going to have to take some ridiculous interest rate to get a no-cost loan. They're not existing because they're afraid of those churning. But we feel what's going to happen as soon as everybody goes back to work, a lot of the biggest concerns in the financial industry and what's happening at the end is they're re-verifying employment. Now what they're doing is 10 days after we close, they're re-verifying the income, they're re-verifying the employment and deciding whether they're going to buy that product off of the lines. So if you could imagine, that's bad. So we're doing verification after verification on these loans to make sure those borrowers, not just the borrower, but the company is also involved. So the employment issue is a big problem, whether these people stay employed or don't stay employed. The other issue is somebody getting a mortgage and then not making their first payment, going right into this forbearance, because they can do that. They don't have to have a reason. So they can get a loan and then go right into the forbearance. And if they do that, that's a first payment default. Nobody's buying that loan. So that's why everybody's really scared about this. So we lift the mandate. When they, not the mandate, but when they lift the quarantine, I think a lot of that's going to change. I think our market will change, but I do think that as a result of people not making their payments, whether it's 3 months, 6 months, a year from now, it's all going to kind of add up. So everybody should be prepared for what's going to happen in that market, and everybody should be prepared for the fact that they're going to see probably a lot of people needing to sell their homes, people trying to save what equity that they have and that kind of thing, because the options are, when you go into a forbearance, and I've been posting this on social media, and most of you should already know, is that you're not going to get a new loan within 12 months from the time you bring that current. You have to bring that current. So if you don't make 3 months of payments on that 12th month, on that 4th month, you got to make all that payment. If you have a $3,000 a month payment, you didn't make a payment, you got $12,000 you got to pay on the 4th month. You're not going to refinance to get out of that. So you're going to either go into extended forbearance, or you're gonna go into a modification, and then it's up to them on whether they determine if you're approved or not approved for that modification, and then the next step's foreclosure. So there's going to be a lot of people that settles, and the people that did take the option of not making their mortgage payment, it's going to be a year before they can go purchase again. So now we're going to be selling their houses, putting them in as renters, and then getting them into the purchases later. So consult your people and be very careful about what you're telling them, and the advice that you give them based on that. So far, guidelines haven't changed. Might guidelines change? Yes, but right now, Fannie, Freddie, Ginnie, they all say the same thing. Nope, these are the guidelines, 12 months, okay? So creative financing resolves affordability and creates more choices. So here we go. We've got 3 areas: creative things that you can do for your sellers, things you can do for your for your buyers to help them buy, and then things that your lender can do to help them finance. So we're going to go into each one of those. Is creative financing. Sellers may be price driven. Okay, they want to know what they're going to net for their sale. So a lot of it's going to come down to how much, WIIFM, right? What's in it for me? Buyers, they're going to maybe term driven. Okay, how much will I have to put down? how much I'm going to have to pay per month, and how much I'm going to have to pay over the life of the loan. And then our lenders are going to have our eye on risk. So again, and right now, these are very risky times when so many people are going out of work and so many companies are going out of business. So how can I structure the loan to minimize default and maximize interest rate? So that's where you're going with your lender. So those are the things that you have to, that's the bottom line for each one. So creative things a seller can do. So these are the best ways that your sellers can make their homes more marketable and help them maximize the best term and the highest price. Because one of the things that I learned early on in this business is that the more creative the seller could be, the actually and help the buyer and help more buyers get into the property. And I've sold most of my homes in a creative situation. You can end up making more money over the life of that loan than you would if you just sold straight. So your cash investors are your A people. They want the cheapest price for the property, or your flippers or whatever you want to call them. And then you've got your retail people who are, standard, and they're going to pay, market, but you can push over market value if you get a little bit creative. So being creative is going to help your sellers get more of what they want. Maybe now, maybe some later. We'll go over some of those options. One is seller contributions and how the seller can contribute to possibly solving down payment issues, solving cash issues, making payments to buy out mortgage insurance, buying down interest rates, paying closing costs to help a buyer, so they don't have to pay that extra money, and that makes their home more marketable. And I'll go into some numbers on that in a minute, and I'll show you why and how much impact that has. It's huge. For the dollars, it saves the buyer a lot more money, which allows you to get a little bit more money. Seller funded permanent buy downs. That's another way. Seller funded temporary buy downs, where they buy the rate down for a short period of time. A permanent buy down is where they're just buying down the interest rate overall. A short-term buy down is where they're buying it down for year one, then it goes up to year two, then it goes up to year three, but then it gives the buyer that time to move back into it, especially in a market like now where, everybody's, probably going to have less income for the year. But next year is going to be different, right? So we've got that going on. Owner financing, carrying some paper. It's a great way to offset some of your taxes, and have a little income. Maybe it's not the cash that they need, but the income is nice, and then they don't have to worry about if the water heater breaks or if the roof leaks or whatever, because they're just the financier, like the lender. So, and lenders make a lot of money, so the owners could make money, and they're also making that extra interest, which I don't know if you see how much interest somebody ultimately pays. They buy a $500,000 house, and over the life of the loan, they've paid $1 million for it. So it does make you a little bit of money. A contract deed, so you can do a contract deed on the property to buy it, where they kind of wrap the loan. They're basically still carrying the financing. It's almost like a glorified lease option. Make sure it's structured properly and done legally. A seller carrying a second. So right now, with a lot of the jumbo lenders changing their guidelines, and their LTVs for qualifications have actually come down on what the lender's willing to loan, a seller carrying a second can also be a potential benefit. And then also doing a lease option, where they get some money now, they do a lease. They can make a lot of money if they don't need to sell the house right now. Over the long run, we know what happens with real estate. It sells, and the values go up. So doing a lease option isn't always a bad idea, and it helps offset that payment, and it gives them an option down the road that they still have the asset. They've sold it to somebody, they've optioned if that person chooses not to buy it, but they also don't have the monthly obligation. And then seller assisted down payments. So, and that's where the seller can contribute to some of the down payment. Obviously, that's something that has to be approved by your lender, but that can help. So some of that money can work out according to the loan that the buyer's getting. That is limited. and then a wraparound or an assumable mortgage, where they assume the mortgage or they do a wrap on the current mortgage under structure of some type of an AITD or something like that. Again, it has to be disclosed to the lender that that's what's happening, but there's creative ways of doing that. There's other creative ways where creating a trust for a property and buying the trust and then no money's moved. I didn't put that on here. It's a little bit more complicated and it does cost money. You would need to get an attorney involved. It's probably going to spend about $5,000 to have one set up properly, and then you can buy properties in and out of trust. It's a great way of not changing your tax or not changing your property tax. So if you wanted to keep it and you just buy the trust changes hands, the property does not. So just another creative way. If you want more information about that, you can give me a buzz. I'm just not going to go into it. If it's not done right, it's not legal. So the other thing is seller concessions, paying for closing costs, permanent seller buy downs, temporary seller buy downs. We kind of talked about that. So let me show you a little bit about how that works. Are you guys seeing all this? Everybody good? Give me thumbs up. I can see your pictures. Tim's got a thumbs up. Okay, good. All right. So like here's an example of, okay, pay $5,000 of closing costs. Sales price $250. Okay, so what I want to show you here is the difference between paying closing costs and the difference between reducing the price. So I see this, I've seen this a lot, and a lot of times because we no longer present offers directly to sellers, sometimes we got to explain to some realtor who doesn't quite, hasn't had all of the Keller Williams training that they should have, and they don't fully understand how to present this offer. And they come back with a counter. You send an offer and you ask for closing costs. They come back with a lower price and no closing costs. You go, okay, well that's not the benefit. So obviously the problem wasn't the price. The problem with us was we need to finance the closing costs. And let me show you the cost of financing $5,000 in closing costs on a $250,000 price versus a $245,000 straight sale. And if you look, you can see these numbers. Your savings, your monthly savings is it's $30. The monthly difference is $30 a month. The cost savings is $5,000 out of pocket. See how big those numbers can be? $5,000 less. If you put that money in your mattress, it would take you 10 plus years to pull $30 a month out to make the extra payment than it would be to just finance it. So that's why when somebody's asking for closing costs, that's why it's benefit. Move these numbers into numbers, closer to Orange County numbers, and those numbers are 10,000 and 15,000, and it makes a big difference and a very little difference in payment. So that $30 can be $90 on a $750,000 place. So, but still, that's relatively speaking, that's very small, because that $750,000 place, you just saved $15,000 that you kept in your savings, which to me is a smarter idea to keep the cash than to put it down and just go ahead and finance it. But I think financing closing costs and having the seller contribute to it is a very smart way. There are ways that the lender does it. I'm going to get into that a little bit later. This is the better way, just because of the cost difference. Because the rates go up when the lender does it, and that's across the whole loan. So seller pays $5,000 permanent buy down on a 30-year note. Let's say on a $250,000 from 6% down to 5.5%. I'm talking higher numbers. This is a strong economy number. A 6% and a 5.5% interest rates means where our economy's sharp. We're all good. Everybody's happy. Everybody's making money. Our home prices are back down to a reasonable place. Anyways, I believe that it's a government conspiracy driving our interest rates down to drive our home values up, because now we have less tax deductions and we have higher taxes on property taxes and across the board. So when you go sell the home, all of that. So anyways, seller pays that. That translates into $70 a month on a principal and interest savings. But in savings and interest over the life of the loan, it's almost $30,000 of interest saving over the life of the loan by buying that 0.5%. on a 200 per every 250,000. Let's just call it per 250. So take that number, you can double it to 500, you can triple it to 750, you can quadruple it to 1 million, whatever, wherever you're at. That's where those numbers go. So now let's go a little bit. Let's talk about an example. So here I'll give you an example of some combinations on how this is. This is a recent case that I actually handled. Where the borrower had actually paid off debts and asked the seller for closing cost credits, pay off monthly. This person happened to be selling a property. Rather than putting all that money down, they consolidated some debts. They asked for seller contributions, giving the seller his full price rather than negotiating or driving him down. We were able to get the property appraised for that price because the value was there. He was just offering to offset some of that cost. They paid down some of their interest. So what happened was they went from a sales price that was highly competitive in the area that they were looking at, and they were having a difficult time getting their offer accepted, to all of a sudden they moved up. They had an extra $500 a month to afford them into a much better situation. So if you look at this, so you've got the difference between 4% with no MI and 4.75 with mortgage insurance. MI is mortgage insurance, for those of you who don't know. So we've got, get cash to close here is $41,800. That's what they went straight in, 4%. Total mortgage payment was $2,400. On the other side, it was $400,000 with 30,000 down. Total maybe was 2,900. So that's purchased with 5% down. We basically asked the seller for closing costs actually it was 3%. Asked them for 3% in closing costs. With the additional down, paid off some debts. Their payment savings and buying out the mortgage insurance, their payment savings was approximately just under $500 a month. Everything's kind of rounded up to the nearest thousand. So just so you kind of see what that looks like. Now let's talk a little bit about seller financing. So when your seller's in an equity situation and does not need their funds right away, seller financing it can be a great way to go. Can help them get more money, can help the buyer get a better loan. I mean, especially if it's a difference between getting a high balance versus sticking with a standard conventional loan amounts based on county, obviously. Seller finances the entire loan. The seller retains monthly cash flow. They don't have the worry of the property maintenance. Like I said before, usually seller receives a reasonable down payment. So that gives them the money to ensure the fact that the buyer is going to pay the property. If he doesn't, the seller gets the property back. He's already got a bunch of cash. I know a guy that made millions on an apartment complex. That was one thing that he did. He carried every single time they would fail. He did it like 3 or 4 different times. He took the property back. He had a bunch of cash, fixed the properthink back up, re-rented it out, and did it. And he said it was one of the properties that made him one of the most money that he's ever had. It was I think it was like a 46 unit apartment complex in Blythe. So, and that's hard to manage from here. Usually, the seller carrying a second is another way which helps the buyers avoid the PMI. So if they have if there's mortgage insurance, if they're putting less down, the seller can carry the difference to bridge that, so they don't have that. So the other one is there's also a benefit to the buyer in allowing them to have a smaller down payment and avoid the high cost jumbos, like I said before. So, or a high balance loan, which right now are just so unaffordable that they're probably going to have anywhere from 1 to 3 points that they're going to have to pay to get into a loan like that. With the way that they've priced these out of the market right now. Again, those will come back. Banks are still doing them, but if you got to go to the bank right now, you're going to need a 60+ day escrow. God knows what the market's going to look like in 60+ days. So, creative lease and seller terms, out-of-box strategies to help buyers and sellers move closer to close sale. So, lease options. A lease option is where the buyer leases with the seller and has first option to purchase. So basically they say, I want to buy the property, and I just want the first option to purchase. Lease purchase is buyer leases and purchases at the end of the term at a pre-negotiated price. They set the price, they do that. Not as good for the sellers, better for the buyers. Although on the other hand, if we're in a declining market, it could be the difference. So if we're in a shift, we don't know. So the pitfalls of each one of those has to do with the commitment. The pitfalls of the buyer with the lease to the seller has first option is a safe bet. Nobody's really betting on the market to stay. If you're in an inclining market and you want to lock in a price, doing the lease purchase is a great for the buyer, and can be good for the seller if they get what they want and they're happy with the price. They're good. If the market declines, though, the buyer might not be able to get a loan, might not qualify, whatever. But those are some options in a market, on both sides, so you can decide based on which one's going to work best for the situation. Okay, seller assisted down payments. We talked a little bit about that. So that's just with the seller contributing to the down payment, with his from the home sale. Contract sales, buyer must comply to contract to formally own the property. So it's almost like a glorified lease option. If you do this and this and this, the buyer assumes responsibility for the property. It basically takes over. As long as he makes all of his payments, then he can formally buy the property. And then wraparound mortgages, which is where you basically, the seller becomes the lien holder. He basically says, okay, it's a $500,000 home. I owe $300,000. I'm going to do a $350,000 new loan. I'm not paying this one off. I've got the extra 50. You're going to make the payments to me. We're going to make the payments to the mortgage company. And a lot of times you'll get an escrow involved that will collect that money. You have to let the banks know. A lot of banks have due on sale clauses, so you do have to get an approval for that. I've seen that work, especially on a short-term basis and different types of loans. So that's just another way of being creative. So creative things buyers can do. So gift funds. A lot of buyers, they don't have a down payment. Well, they can ask mom, dad, grandma, grandpa, uncle, brother, sister, nephew, cousin, whatever, for funds. They give those as gift funds. A lot of the programs, especially our agency programs, allow gift funds. FHA allows 100% gift funds for purchases. Some with some of the conventional loans, some of the money has to be some of their own, although using gift funds can help them offset the down payment and get into a property. That's a great way. It's probably one of the first things that we do when we see a borrower who doesn't have any money. We ask them about their relatives, and we start having conversations with them from the lending side about helping, who might help you with purchase. The other thing is I've helped family members personally myself, because as a real estate agent and being related, I could actually gift the commission. So if I can talk to a seller and, they can, bump the commission a little bit, we can, work that out on the buyer side. I can help the buyer, and you guys can do the same thing, especially for family members. You can gift them your commission. I think we did from one of our agents in Keller Williams' office. Selling and or refinancing existing assets. So they can sell things. They can sell their bikes. We have to document it. We have to document that it's a sale. We have to document that they had full ownership. We have to see the cash come, the whole thing. But they can also sell things or refinance assets. If they refinance something, we're going to look at that new payment, make sure they still qualify. They can bring in co-borrowers, non-occupying co-borrowers on programs. So, and we do this a lot, where it's a family member or a grandfather or somebody else who also helps them co-sign to buy their property. And that's another way. They can use 401k. So they can leverage their money out of their 401k. They can temporary IRA transfer, pledged asset mortgage, and equity transfer and bridge loans. So from other properties. So if, let's say, they have something to sell and they want to buy this house, they can use a bridge loan to use the down payment to do a purchase, and then, you know, be confident they're going to sell or rent the other property. But bridge loans are typically temporary and at higher interest rates, or they can do equity transfers. And there's a lot of companies that have employment assisted mortgages. So that's another thing. And in a lot of cases, we see people with just the credit score just doesn't allow them to get to that point. If you're at a 580 or lower on an FHA loan, we require more money down. So you can't put 3.5% down. So sometimes it's just a matter of repairing their credit and helping them do that. Those are the ways. So family members who can qualify for GRIF funds would be parents, siblings, grandparents, nonprofit agencies, non-occupant co-borrowers, local, state, and provincial agencies, and trade unions. So those can be sources of gifts. Those people can actually give gifts for the down payments. Creative things lenders can do. So let's talk about what we as lenders can do to help your buyers buy. So let's say you don't have a cooperating seller and you don't have a cooperating buyer, and there's some things that we might need to do to help them get into a property. Well, we have lender funded buy downs. Right now, the rates are so low, it moves the interest rate up quite a bit to get those lender funded buy downs, but they're still available. We still can do those. Fannie Mae's My Community Mortgage. Scott or Ho, is that one still available too? Or is that gone now? Either of you know? Scotty? That looks like they're on the phone. I see Steve's on the phone. Anyways, just so you know, a lot of these some of these programs are temporarily suspended. I've taken the ones off that just aren't probably going to exist for a while, even after. The down payment assistance program has, in most states, there's still some people that will say they'll do it, but I'll be honest with you, they're probably not going to close because they're pulling that program as we speak. So we're no longer accepting applications for down payment assistance programs because we're not going to have investors for that. There might be some other temporary agencies that are city or county specific that we can use. That's great. Let us know. We get registered. We'll get the information. But I'm just saying, so some of the down payment assistance programs are going away. Running scenarios. So another thing that we can do as lenders, if we can run different scenarios through our automated underwriting systems, which kind of tell us, well, if we did this, maybe if we paid this down or we do these things, we can get them into a certain structures and certain loans. And then we tell them, this is what I need you to do. And if they can do that, we can help them with that. So we can do some scenarios in our system to help to see if we can't help get them qualified. Adjusting amortization period to lower the payments. So going from a 30-year to a 40-year mortgage or something like that can also help them qualify. Adjusting interest rates to cover closing costs. So again, better to come from the sellers and finance it in the home, but let's say there's not any room for that. We can adjust the interest rates a little bit and cover the closing costs. We've done that a lot in the past. But right now, with the interest rates as low as they are, the cost to do that, we got to move that up quite a bit. So sometimes it gets a little bit too expensive, but there is some room and we can do that. Mortgage credit certificates. Those usually are something we're gonna do with a down payment assistance program. Basically, they're called MCC. It's a document provided by the originating mortgage lender to the borrower that directly converts a portion of the mortgage interest paid by the borrower into a non-refundable tax credit. So talk to us about that if you want to go there. Again, does that exist with any programs that we're currently doing right now? I don't know. The market's moving a lot, but it is and has been an option in the past, but every day it's changing. First and second loan combinations. I mean, this one's huge. We're using this a lot where we find so with the jumbo pricing being so often, a lot of people in jumbo and high balance, they don't want to put the down payment required. I mean, or the difference required, because now they're asking, rather, they used to do a 90% loan, now they want to go to 10%, or you got to pay all these points if you move into that thing. So you say, no, I want a conforming first loan. So give me a loan that's conforming, falls within those guidelines in that dollar amount, and then I can get a HELOC up to almost 90%. And that also eliminates mortgage insurance. So when you do that, they don't have the mortgage insurance. They get an 80% first loan or less. Again, it's whatever that conforming loan limit is. And then they get a second HELOC that's over and above. Where that shifts is when that HELOC gets over 150,000, and they go, wait a minute, I got an adjustable rate. It's a second. So a lot of buyers get a little sketchy when it gets a little bit bigger. But I mean, the interest rate combination is, I mean, you're talking, you got like a 3.5 interest rate on the first and a 4% on the second, which is adjustable, and the rates are good right now, and I think the rates are probably going to get better even after all of this. So I don't know that that's that big of a I guess a risk for the borrower, but it's a great loan combination. It's a great way to help your borrowers keep their interest rates down, get a better first, apply that money to the second, use that second. And the seconds are free, so we don't charge. I think the charge is like $750 or something. It's just nominal. Anyways, private lending and cross collateralization. So they can use a private lender to cross another, maybe they own some other assets, or they have family members who say, I don't want to sell my house, but I don't mind a little loan and doing a cross collateralization on it. Alternative documentation programs. Again, a lot of those are gone. Those are available in the private lending world. So the interest rates and all that aren't like they were. So it's going to be much higher than it used to be. I mean, we're seeing rates in the 4s, and we're not going to see those right now. You're going to be in the 6s, 7s, 8s, those numbers. Same with the no doc programs. No doc program is going to be equity-based program, probably coming down to private lending, and a lot of the private lenders aren't doing it. Those programs really exist for non-owner occupants, because on owner occupants, they fall under all this government solved situation, which means that they can go in there and not have to make a payment for a year, and you can't foreclose on them under the current situation with COVID. So again, down payment assistance program, again, another one, which is a great program, where they get a loan, a second loan, and then a third loan to pay closing costs, and allows them to buy a home with no money down. But those are gone. It's probably a better way a combination of doing a gift plus a closing cost credit or something like that. So, and then again, we go back into our buy downs. So one of the things I talked about was credit nurturing. And, one thing about credit is damaged credit scores can be repaired. It takes time and it takes planning. So when you have a homeowner who, or a non-homeowner who wants to buy a home, when should they start? Well, I don't want to buy for 2 years. Start now. They should always start as quickly as possible, because the better we can help them with their credit scores and get them into a program that helps them manage their credit. They can sign up for some of these free ones where they can do it online. We have individuals that will help them with credit solutions or solve credit problems that will help them push their score up. The higher the score, not just qualifying for a loan, but getting a better interest rate. So pushing that score up will help. All these things go into it. Payment history goes into it. Age and type of credit, how long they've had it. If you've got kids, you should be getting them as soon as they get 18. Get them credit cards. Have them put some balances on those credit cards and pay those off. So those are great ways to help them establish credit, because the length of time that they've had that credit is important too. If you need, if they're a bunch of nitwits like we have today with these millennials, maybe you have to manage that for them. But I'm just saying, it's a great way to help them get a head start in life when they go to do something. The percentage of credit use is probably one of the biggest numbers that highly influences it. I mean, you can see, you can see here which one extreme influence was payment history. Highly influence is your age of credit and how long you've had it. And then another highly influence is the percentage of use. So you want to have those numbers at 50% or below. 40% is the best. If you never use your card more than 40%, but you do keep it balanced and make payments and have that for a while, then that's going to definitely help you get your scores in the 700 range, or higher numbers to help you with that. Total balances of debt moderately influences doesn't I mean, you have $100,000 worth of debt, but if you only owe 40,000 against that debt, well, that helps. It's all the percentages has a bigger influence. Recent credit behavior, less influence. One of the things I see is somebody says, "Oh, I have this collection that I've had for years, and maybe if I just pay that off." The problem with doing that, you need to check with someone first, is that when you pay that off, all of a sudden that becomes active and it becomes current today. So you got to be careful that you don't bring that old history into your new history, because that length behind that has also helped raise your rate. So sometimes that can be an issue by the way that you pay those off. You might want to have a credit person help eliminate or get that removed from your credit so it's not on there, and then you can address paying it off so you don't have that hanging over your head. And then the least would be how much available credit that you have. So those all go into your scores and help you with qualifying. But credit is everything. And one of the key things to help any of your borrowers is to help them with their credit. We can do analysis. I have professionals that we use that within minutes they get back to me and say, do this and this and this. And they charge nominal fees to help borrowers. I've helped hundreds of borrowers do stuff. That was weird. That just popped up right in front of my face. Hold on. Okay. So next, 1, 2, 3 debt consultation. Okay. Borrowers can structure their financial situations to gain purchase power to accelerate their retirement and move up or down. So this is another way of mortgage debt calculations, mortgage and debt calculations to help people offset savings. So if their balance, let's say they have a balance on their mortgage, they have a $400,000 mortgage balance. Their payment is $19.10 a month. They have debts of $19,000, which they pay $950 a month on. And so if you did it, we did a whole brand new loan of $419,000. Their payments of would be $2,860. Okay, their new mortgage would equal an $860 a month savings. That's $860 is what they're saving by taking those current debts. So this is on a debt consolidation, car payments, credit cards, that kind of stuff, consolidating into mortgage. Yes, you're extending that into a 30-year mortgage. I understand that. But if you took that $860 and you applied it properly, and which I'm going to show you right now, and you take that $860, that's your lower purchase. First off, that gives you $860 more purchase power. So you could buy more of a property, you could afford more home, and that $860, based on these interest rates, equates to substantially more on your power to purchase. And then if you look at your debt savings, your new mortgage versus $860, here's your equity savings by applying that $860. So the amount of money that you save in the long run, I think, outweighs the short term of, well, I gotta, only have 5 years on my car. Well, so what? Look at how much more equity that you're going to have over the life of the loan. That's going to more than cover what your car is. Anyways, so let's talk about some of our current loan program options. And just to be clear, there's a huge change in the mortgage industry. A lot of brokers are having difficult times because what a broker does is they go to investors. It goes to separate investors, wholesalers, where they sell their money. They get their loan, they package it up, they send it to that person, and you have no control because that lender can change their guidelines. That lender can wipe, and that's what happens when a market shifts like this. We find that, I mean, that is the biggest issue with brokering and not having in-house staff and that kind of thing. Our company, SunWest, has done the same thing. They had a wholesale channel. Well, they bumped their rates up so high that nobody's enticed to come there. And the reason they did that is because they wanted to use that wholesale for their retail, which is more important to them. So their retail is more important to them. It's the service that we have, that we offer our individual agents. So when you're doing a purchase with us, we can guarantee those closing timeframes and all that. So we've used all those resources for the retail side. And what's great about SunWest is that they haven't changed their guidelines. So a lot of companies have not only is the pricing all over the board, and a lot of that has to do with the investors that they go to. We have our own programs. We service our own debt. It all stays in house from start to finish, but we're still operating on the same time frames. I mean, we might add, like, there might be 3 days combined when you add everything up, because one went from 24 hours to 48 hours, and this one's still same day, you know, that kind of stuff, where throughout the loan process as it flows. But all in, we can still close a loan if needed in 21 days. Give us 30 because everybody's busy. Some of the issues are going to come from our appraisers and access to properties, and a lot of that, especially right now. So there's third-party things that will slow you down, probably more so on the real estate side than it is on our side, on the lending side. But a lot of our competition is, 45, 60 days. Most of them aren't allowing for locks because it's so inconsistent and people are employed. We're still locking loans. So we're still able to lock on a pre-qual. We're still able to lock them before, so they make a commitment to a house. They can actually we can make a commitment to a payment for them on that house, which makes a lot of sense. It keeps your deal from falling out. A lot of the other lenders are saying, no, not until everything's in and we're ready to go to docs can you lock your loan. So, and then that's a gamble at the same time. So we have all of the programs. The ones that we don't have that are a little bit more difficult is our jumbo. That one, the alt doc is gone, and the down payment assistance is gone. Bank statement loans, that kind of stuff, that's gone. Other than that, conventional FHA, VA, USDA, we can still do our combos. We do still have, well, this is jumbo interest only options. That's gone for right now. Sorry, I should have crossed that out. We still have all of the other with doctor loans, renovation. All of those loans are still exist in our capability. We still have the ability to broker. So we still can broker loans out as we find. We still have the same FICO scores. We didn't change our FICO score requirements. A lot of the FHAs went to 640. Most lenders are saying we're not going to do anything less than 640 anymore. We're still at 580. We'll do sub 500s. We don't have a FICO score requirement on an FHA. I think it might be in the 500s. But when you're talking about your minimum down, 580 is where we're going to be at. So VA options is no FICO score is 500, conventional 620, jumbo. Whatever. Jumbo and Shadat, let's not even look at those right now. Sorry, I didn't take those out of this screenshot. So the other thing that's changed that you have is your flippers and your home restorations. This slide used to say fix and flips and flip money. We give credit lines for flippers, and not doing that right now. That one's gone. That went away with your alt doc programs, and a lot of people's insecurities about what our equity positions are going to be based on unemployment rates being as high as they are right now. So, but what you do have available are solutions for homeowners who are cash poor but have equities. We do have home restoration loans through some of the builders that we work with that will go out, and they'll basically, if the borrower or the homeowner qualifies, they can get a loan. The builder can get a loan to do the fix up and help them fix their home up before they sell. So if they have equity, but they're cash poor, and rather than selling their home for, you know, 750,000 on a flip, they can, you know, to a flipper, they can sell it for $1 million by doing, you know, $50,000 or $60,000 in home improvements. Well, then they get to keep the equity. So homeowners wanting to capture more extra equity by fixing and flipping, this is ideal. This is something you go to a homeowner and you help them with. I think the biggest issue is that they're going to have to go through the construction process while living in the house. If they have an option of moving out, it's better, but it's according to what needs to be done. And then that's saving the equity for the homeowner. That also is helping your community and your farm, and everybody, you know, gets to retain, you know, higher comps for their neighborhood. And then also the homeowners can partner and sell, partner and or sell to flippers using creative financing option. I know Alan's on the phone, or he's on this call right now. They have a great program that he introduced to me that helps people, you know, who want to get rid of their home, or if they want to buy the home, they buy it creatively. They do it on a wrap. So that's one option, and or they can partner with some of these people, which will, you know, they come out and they get funded. There's a company called Hearth out there that funds contractors and homeowners. It's a loan program that the homeowners get, and it's an unsecured line of credit, basically, to fix up their house. So, and that's still available, oddly enough. So here's the point, though. We're here to help you. We're like the government. No, just kidding. I'm with the IRS, and I'm here to help. No, you don't have to master creative lending. You just have to master how to dial the phone and call us. So how about that? So if you're unclear or you're unclear of understanding of the market, the players, their options, we'll consult with you. We'll consult with your clients. We'll do it together. We're here to help you. We're here to help. We want to be your financial division of your business. And we're competent and confident that we can add tremendous value and service to your business, especially in a shift market. This will be my fourth or fifth, maybe fourth crash in the, is that Tito's? That's nice. Good job there, Ho Ho. That's the way you quarantine. That's the way you kill the bacteria in your throat. But we're here to help you guys. So please give us a call. We'll be your resource. We have, we can still help you close on time. We can still do guarantees. I mean, and just to kind of go brief through this, we can help you with winning offer structuring, larger down payments, some of those things. But we still will pre-approve a buyer prior to finding a home, so they're underwritten approved. So it help you can you can remove contingencies. Just add the COVID, and you don't have to put anything else in there, right, Jan? Jen? Got the COVID, you can get out for no reason at all. Anyways, but we can help you guys. So we can help you structure the offer. The smartest thing for you to do is back into an offer structure based on the buyer's financing anyways. So come to us, then we're going to work together with you on saying, hey, if you can get me 2% in closing costs, we've got this deal's golden. Or maybe we can get the seller to contribute, or maybe we can find homes where the seller's willing to carry a little bit of paper and this buyer can buy. So all of a sudden you've created something that didn't exist before, and we can help you guys do that. We also can help you guys with some of your social media. We're working with a few agents right now on their social media. My son finally is getting onboarded as we speak, and we just had to get some licensing stuff worked out for one of his states, and he's going to be in the back end making some phone calls. So if you guys need help with lead flow management, any relevant campaign creation, we have some great campaigns that we've launched ourselves. We're really busy right now with a lot of people wanting to do refinances, but that's slowed down. So the rates have kind of hovered where they're at. So we've got everybody locked. We're happy with that. We had 3 people we had to kind of make work, And outside of that, we're all good to go. So we're looking for new loans. We're looking to help you guys build your business and help do some purchase business. That's our number one focus, is to help you guys do more business and utilize us. I mean, let us be part of your ISA team or whatever and help you do some lead conversions. You have leads in a platform, and if you're not calling that, I mean, you have to have 12 conversations with them before they convert. So most real estate agents give up after 3 if you're like me, but we can help. So we can help with that. We have some great campaigns, automated campaigns, programs, which are, we create these long campaign communications where it communicates and it gets them on the phone and it says, I'm going to put you on. They say yes, they hit a button on their phone after they get a text, picks up the phone, it calls us directly. We convert them, get them financed, get their financing in order, and you go show them houses. So let us help you with doing that. And obviously, as soon as we can help you with your open houses again. So we're Christian Brothers Lending. We're with SunWest Mortgage Company. Thank you very much for your time. Thank you for listening to our presentation and educational class. And I hope you guys all got something from it. Do I have everybody muted? Wait, I think I have some questions here. How do I move this? There we go.